Drew, Meredith, thanks for taking the time out, mate, and doing a bit of a reporting season recap with me.
Thanks for having me.
It's
from my home office.
Yeah. It looks you got the premiership photo in the background there, like all framed. It's interesting times for us here in Melbourne. As you can see, yep, at the home office as well. Everyone else in the rest of the country seems to be doing it all right, but here in Vic, stage 4.
Yeah, I don't think I've left the house yet. So
yeah, I think
for the day, not for the month.
Yeah, well, I think it's been 4 to 6 weeks since I've been into the office and we've worked together. So that kind of puts it in context for people that are in a different state. It's interesting times, but maybe I should just start by filling in a bit of your story and how we know each other. So our businesses are aligned. You run a financial planning business along with Jamie. You own a stake in my business, which is the Rask Group, and I think our businesses complement each other really well. Like I said, you're a financial planner based out of Melbourne, but you also do every quarter this insane amount of research work on ETFs, on managed funds, and on listed companies. So I feel like I'm privileged to be in your company here, mate, as we go through some of our favourites.
I'm still trying to count how many words are right. Nothing else to do, so that's all I say.
Yeah.
So what else can you do when you can't go out after 8 o'clock?
Yeah, true, right? Like it's, you can't go out after 8 o'clock. You can't even leave the house during the day. So, I mean, why not just research stocks? And what we thought we'd do is, because we're going through so many annual reports or half-yearly reports or just company updates, we thought to make sense of all this, why don't we just pick 2 companies, 2 popular companies, talk about them for 10 minutes each or so, and then let's just say what we're looking forward to in the week ahead. We'll do this once a week, publish it every Friday, and see if people like it, and ask us questions or reach out if they have any suggestions for future recordings. But I thought I'd just go over my company, which is Commonwealth Bank. Probably no points for originality, and then maybe I'll hand it over to you to introduce yours in a minute. But just some of the headline figures from CBA, we saw that net profit was up 12%. We saw that the cash profit was down 11%. And the big driver behind that was the divestments, particularly around Colonial First State. So cash profit down 11% to 7.3 billion. I guess the thing that everyone was looking at, other than the dividend for once, Drew, was what happened. Other than the dividend, of course, What happened to impairment expenses and what kind of provisioning is the bank making for all of the uncertainty that we're seeing? You know, I've got some numbers here where they said 135,000 home loans, on deferrals, 59,000 business loans on deferrals. That's, for people that don't get into the weeds on accounting very often, I mean, that's a lot of uncertainty that they have to bake into the financial statements. And so that's something right there which kind of jumped out to me. When you think about that, mate, what do you think when you hear 130,000 loans on deferrals or holidays?
My first thought, and the thing I get worried about, is whether people know that they're still being charged interest on that. You know, that it is still compounding interest on their loan. And I think, unemployment, I think, came out today. There was about around 10%. So there's probably more pain behind those numbers than we know about at the moment. I noticed the CEO, Matt Common, talked about switching some of these deferred mortgages to interest only, which I think is actually a reasonable strategy. Reducing the cash flow pressure, and might delay your mortgage repayments for a while, but it looks like it would be in the best interests of their customers and them. Maybe a win-win, which is rare for a bank.
It's just there's just so much uncertainty, right? Like we have not just people on holidays from their loans, but then you've got to think of, okay, well, what's the true unemployment rate? And then you look at the businesses, the small, medium businesses. A lot of us are critiquing the listed companies here, and we're talking about, how much of your income is being propped up by JobKeeper or subsidies or whatever. But when it comes to the private market and smaller businesses, which make up a lot of the bank's lending, what's the mix there? And there's really no, like for us at least, it's very hard to get that transparency. And I read something actually from a media report from Creditor Watch, and it suggested that the payment terms on small business, credit cycles. So how long does it take for someone who invoices a small business to get paid? And across all industries, what they found is that year over year, in July, there's a 220% increase in the time it takes to get paid. So, I mean, when you're thinking about provisioning for this type of thing, there's multiple layers of uncertainty in my mind. And I'm thinking, it's very hard to say, yes, the bank's made a provision here, but is that the right amount? Is the worst yet to come?
Do you think there's more deferrals in there, or do you think there's more mortgages under pressure than the ones that are deferred at the moment?
I think there's a lot more pain in store. I think, not to sound so doom and gloom, but I think that's kind of obvious that, we're still seeing the ripple effects here on a lot of these small businesses, particularly in Victoria. I mean, it's too early for us to say what the implications are because we're still in it, right? Other states, it's a bit clearer, but here in Vic, you can't even walk down the street, but if you could, you'd realise that it's not looking great. So, I mean, all this is to say that, we'll get to some positives in a moment, but that kind of jumped out to me as something that I was a bit concerned about. Conversely, we saw that home lending growth grew at 1.3 times system over the year. And so that says that, the business is growing, I guess, ahead of its competitors. That's a double-edged sword because if it grows too fast, then you've got to question why is it growing so fast when everyone else isn't. If it's growing too slow, you're thinking, are you not being aggressive enough? It's kind of a bit of push and pull there, but I thought that was a positive. The other positive, at least for shareholders, was the dividend, 98 cents.
Right at the cap, wasn't it?
Yep.
0.05% left over.
Yeah, APRA wanted it below 50% and they got it, 49.95%. It feels like that's a perfect mark.
I was kind of interested in the, I think they got 15 billion in new cash deposits. Did you pick that up in the statement? So their loans are something like 74% funded from deposits in the bank, which I kind of took as maybe people taking money out of super and putting it into their offset accounts and benefiting the bank that way. But that's a pretty secure position for a bank and a cheap way to fund their operations is, people with cash in the bank paying next to nothing. So and that's really a highlight.
I think that's, again, I think that's a pretty big counterpoint to the doom and gloom that I was probably preaching a little bit earlier on. I think you look at the bank's capital structure and it's probably one of the best in the local market in terms of deposit funding for one, particularly at the scale that it is, but also with the CET1 ratio, that common equity tier 1 ratio, which kind of is the official measure. And it's so far so good with CBA. It's above the regulatory minimum. So I think those two forces are acting in the best interest of shareholders. We've got to speak. It would be remiss of us not to talk about the dividend, Drew. 98 cents per share, which is well above what the analysts are forecasting, which was 67 cents. So, Murphy's Law, I wrote an article 2 days before saying, is CBA going to pay a dividend at all? It comes out and beats expectations. Of course it does. And the shares came up on the day, but that's a 4% yield if you're using historical figures. Obviously, we're not looking into the future with that, but 4% yield is pretty respectable in this market.
I think that's what people have to get used to as well. I've been writing a lot about it at the moment. There, a lot of retirees in particular are used to getting 6.5% or 7% from a bank, but a dividend of that size means the company is paying all of its profit. So I think everyone has to get used to a yield of closer to 4, at least for the next few years, as these companies recapitalize and kind of reinvest in themselves. Because everyone has to change post this pandemic, when that happens.
Post. That's the key word.
Mid-pandemic, we tend to be more negative too because we're in it still. That's probably why you thought there'd be no dividend. Where
recency bias, right? Like I'm just getting caught up in my day to day. But I think what's interesting about that, right, is I heard it put to me the other day that the banks were just looking for an excuse to cut the dividend. And I thought that was an interesting way to frame it because the banks have been paying out a lot of their profit as dividends for a very long time. Admittedly, they've been able to afford it. But maybe now it kind of resets expectations of investors. It's outsourcing that responsibility to say, we've had to do this, fair enough. And now it's, we can incrementally get back to paying a higher dividend in time. But in the meantime, we've got this capital hopefully available to reinvest in the business.
You look at what happened to Telstra a few years ago when they tried to cut their dividend. they had to release themselves from it so they could then focus on, changing their business towards growth opportunities. But the share price was down something like 30 or 40% for an extended period of time. So it took investors a while to realise that the companies were changing. I call it the Telstra effect. It kind of happens to quite a lot of businesses where you just get anchored on a dividend rather than remembering that the company needs to it's being disrupted from every angle. So.
Yeah, I think we've got some. I know you've made a note of this to talk about. You've actually got another company that could be going through the Telstra effect itself. I figure I should just tidy up this bit here on CBA. One thing that stands out, which is really important, is the net interest margin. We saw a mild compression on that, down to 2.07%. It was two basis points lower, or 0.02% lower for people. We've been seeing that trend in recent years as interest rates get lower. The amount the bank pays away, yes, the term deposits are really good, but the reality is that the lower the interest rates go in a falling rate environment, the harder it is to widen that margin and to make money on every dollar of lending.
They've kind of been saved by the RBA so far as well. So they've capped funding rates at about 0.25% in this period. So your net interest margin would probably be even thinner if it wasn't for that. But I'd suggest that'll stay for quite some time.
Yeah, and that was going to be kind of like what I'm going to watch for next. I mean, we've got NAB coming out Friday morning. We've got ANZ coming out next week, and those are the kind of the commentary around that. And I guess if there's any at all, it will be something to watch for. But I think it takes. I think maybe some investors underestimate how long it takes to unwind that effect. And I tend to agree with you there that over the next 3 to 5 years. It's hopefully we see that net interest margin come back a bit, but it could actually take some time to, if you go back 10 years ago, talking 3% net interest margins or more, that's a very profitable bank. Maybe we see that 5 years ahead of time here in Australia, but I think it's going to be pretty tough.
Yeah, this has kind of brought Australian banks back to where the global kind of average is. So most banks are valued on price to book. CBA was the most expensive bank in the world. It traded on something like 2 times price to book. And now most Australian banks are back to 1 or just below 1. So some people would say historically that's good value, or it's probably fair value at the moment. So you agree with that?
Yeah, I would say that's probably, I think there's 2 ways to value banks pretty well. One involves more of assumption, and the other one is kind of that historical analysis, which is price to book. We know that some of those books are worth more than others, depending on the quality of the lending. So you could maybe say that CBA deserves to be priced a little bit more because it is such a good bank, versus say another bank like a regional bank, which should trade at a lower multiple. So yeah, I would agree with you broad strokes there. The other way to value it would be a dividend discount model, which is probably not much fun right now when you're trying to guess what the next dividend is. But yeah, I would probably say that. And so jumping the gun a bit here, but I would say if I had to buy, hold, or sell this, like what was my label on it, I'd probably go with a hold, probably because, I think banks always have to be profitable, and I don't think there's any issue with that. But I just think there's a bit of uncertainty around the interest income piece, how the credit provisions factor in. And then, we've seen a lot of divesting going on in the banking sector. So I don't think we can value banks how we have traditionally insofar as a lot of that non-interest income. So things from like wealth management, we saw the Royal Commission shake a lot of that out. So I don't think that it's right now at this price is kind of like a market beater. So for me, it's a hold. I wouldn't sell shares necessarily, but it's a hold. How about for you?
Yeah, I'd agree with that. I kind of want to see how the housing sector plays out over the next 6 to 12 months, which is kind of linked to immigration as well. So if borders stay shut for a year, even that could really slow down immigration, which will hurt our property sector. So totally be important for longer term for CBA. So hold for me as well.
Yeah, there was something before we get to your company. There was actually something, Drew, that you mentioned off air just to me a few minutes ago about the PEXA platform. I know you wrote an article recently for, I think it was Inside Investor, and you wrote it for Rask as well, which was an article around link administration and its PEXA platform. Maybe can you just tell us what that is?
Yeah, so I bought and sold a house in February this year, and apparently they don't do in-person settlements anymore. After signing a contract to sale, we get a text message from this group called PEXA. You sign up to an app, and basically your mortgage broker or your solicitor uploads all the documents to a digital settlement app, and it all happens online without any people attending in person. I think CBA reported that 80% of their settlements are on there, on this digital settlement platform, and it is the only digital settlement platform available in Australia at the moment as well. So, kind of an interesting diversifier for Link admin group, but also the future. It's really a disruptor. The future of settlements is no longer in person. It has to be digital, like everything else is going. So.
Well, I'm buying a house at the moment, Drew. So if we end up going through PEXA, I'll let you know and I'll update you through here. But that's
well, you won't have a choice.
yeah.
They have asked for it as well now, apparently.
Right.
All these states and countries realise that you can't stop the economy, but not being able to meet in person can actually stop old-fashioned deals from occurring. So they're finding ways around it.
Well, it's interesting bringing forward that adoption curve. A lot of these businesses, and now all of a sudden, it's not a question of, we'll get to it. It's like, you have to be on this platform now. So it'll be interesting to see how that plays out. I'll hand it over to you now, mate. I've been through my stock. A bit of a blue chip. I think you've got one for us too.
Yeah, this one took me quite a few years to buy, or to advise my clients to buy. I've kind of historically been a bit of a value investor. So it's SEK Limited for me, the job ad placement agency platform. Headline numbers weren't particularly good, as you probably saw. The share price was off, was it 12%? Profit fell about 50%. And then as the accounting or the statutory loss was about 110 million. So they lost 110 million for the year. Big chunk of that was $200 million write down on what are their growth investments. So SEK's almost a combination of a job platform or job advertisement platform and a growth investor. They have a separate business unit called SEK Investments, where they buy fast growing, similar, almost ancillary services within education or training. And that business invests into smaller companies in different areas of the world. So every quarter they have to write down or readjust the value of those assets. In this case, it was down by 200 million. There's every chance that that's revalued upwards next quarter.
Would you say that's so? Would you say it's more reasonable then to follow the underlying results of the company?
In that case, I think yes. A revaluation of an ongoing asset, and one that's growing, according to them, was at about 35% sales growth this year again. All the underlying businesses, that is. So yeah, I think you can rely on underlying in this case. And I think that's kind of why I think analysts might have missed it a little bit. They weren't expecting such a big write down, and that's why the share price probably came off as far as it did. The other headlines were revenue was only off about 2 or 3% in total. Australia fell 12%, but the Chinese business Xiaoping or Xiaopin, we were practicing the pronunciation before, that actually grew at 12%. The revenue of the Chinese business is about half of SEK's total revenue, but only about 20% of its profits. Whereas the Australian business is about 30% of revenue, but something like 50% of profits. So probably the big disappointment, not that I buy SEK for a dividend, was that they cancelled their dividend. I kind of see it as a positive. The management spent something like 130 million on investments, and also constantly improving their own platform. So freeing up another 100 million to reinvest in themselves, I think, is a good thing. And it hopefully staves off the need for a discounted capital raising anytime soon. That's probably the core driver of the dividend cut. What are your thoughts?
Yeah, I've got to admit that, so SEK is kind of this business that I've followed on and off for years. I can't say that, maybe I held shares many years ago, but I would have sold them not long after. So maybe it was just that regret that meant I never went back. But it's such a dominant platform here in Australia. And I know the management team have a lot of involvement with innovative companies throughout Australia. And so for me, it makes sense that the business would use this cash cow, which is this super dominant platform, and then put that into new moonshot style investments, if you like. And, some of them are starting to pay off. We've seen the increase to online learning, for example. It's not just here in Australia where SEEK's benefiting from that. It's also over in the UK. So, that diversifier wouldn't have been possible without that early stage investment, or even into Coursera.
Coursera, yeah.
Yeah. And then, so that's those two pieces are probably really appealing to me. Combining the cash cow with these moonshot investments, it makes it hard from 6 months to 6 months or from year to year, because you do get these wild swings in amongst everything else that's going on right now. So I would say, I would agree with you. It's from a cash flow perspective, it's a very strong business. I think the headline figure was that, or the headline operating ratio for me was that it's something like, was it 5 times the nearest competitor in terms of job ads in Australia?
Yeah, 33% of every job taken, I think in a rolling monthly basis or something, is by a SEEK. And 35 million site visits a month. So it's clear they've got a monopoly. They're not sitting still on it. They're constantly trying to improve it, but they're using the profits that spit out of that business to stay relevant in the future. I'm kind of cliched. Call it the new, or the closest thing Australia's got to an Amazon, just because it's a company that profits on one side and just won't sit still, constantly trying to improve.
I guess in my mind, it's kind of one of those businesses that there will always be a need for jobs and for employment, and for new, for candidates to apply for jobs and companies to need labor and that type of thing. But I think if I was to say put it next to car sales, I'd say it's almost even more cyclical than car sales, because you can sell a used car in a downturn, or, when the economy is doing fine. But with jobs, you are kind of beholden a little bit in the short term to that unemployment figure. And so if you don't want to be there on the way down, but on the way up, that could be quite a ride. I think you were saying off air that you kind of recognized that during the March, I guess, sell-off. And you
took we watched it for 5 years, maybe 10 years, and they report on the front page of their annual report that the returns from SEEK since inception are 25% per annum if you bought it at float. We could never justify buying it for some reason. And then in March, it dropped to about $16 or $15, and we saw a great opportunity. Made the big call to buy it, and a 30% profit in about 4 or 5 months now. Yeah. But it's a company we won't sell now.
Well, those are the times when you get these companies, right? It's not during the every other day. It's the times when there is so much uncertainty that you get the chance to buy these businesses. Drew, one thing I might ask you about is about the balance sheet. I noticed it's got a fair bit of cash, but it's also got a bit of debt. But do you think there might be something to that?
Yeah, so the Chinese business, the way I understand is owned in a separate vehicle, similar to like Atlas Arteria, like toll roads, having separate assets and separate vehicles. So whilst the headline debt looks large, the covenants attached to that debt in Australia, that would force SEEK to do a capital raising, are only attached to the part associated with the Australian company, not to the Chinese business unit as well. So there is sort of not necessarily cash guarantees, but or loan guarantees, but it doesn't look. But what I'm trying to say is not as leveraged as it looks to be on a headline.
Yeah. So what you're saying, even though we look at debt and we think that's kind of our downside, you could kind of slice that and dice that a few different ways. So you kind of know how far down you got to go for the Australian entity versus the whole business.
The Chinese debt's really only attached to the Chinese company. It's probably the way I'd explain it best.
Yeah. Well, and it probably makes a lot of sense. This business would have has invested a lot of money into growing that Chinese business. I remember when it was announced many moons ago, I thought this is a very appealing business model to take what you have here in Australia and effectively apply that overseas. And it's doing just that. And many years later, it's seeing the fruits of that, but it did cost a lot, right? So you've got some cost there that you need to take into account.
Still barely penetrated. It's still only something like 5% of businesses are using it in China as well. So it's
right.
a massive opportunity. And the interesting part for me was that the investments that SEK are making in Latin America and other areas of the world at the moment, that's how the Chinese or Xiaoping actually started for SEK. It was almost an outreach investment that's grown into a core part of their business.
Yeah, right. So I guess all of this combined, Drew, would you say it's a buy or hold or a sell? Or I think I know
I'm
which
still
way
buying.
Yep, still buying.
I don't mind the dividend cut. The only thing I'm wary of, depending on what side of the bed I get out of in the morning, if you see a lockdown in New South Wales, then I think it would push it closer to a capital raising. Dividend cuts the first part. They did raise subordinated note, so some extra funding not a few months ago. But if there's a real lockdown in New South Wales or China, I think they'd probably need to raise capital. That's the only thing I'll be watching out for.
For me, I'm a bit more risk averse, I guess, in that respect. So I take those concerns. And we've got the AGM in November. So that might shed a bit more light. Like it might give a bit more clarity then, like just a few months down the road even, we'll know a lot more. So for me, I think it's a really good business over the long term. And this is why I'm torn, because I always say to people, if you think it's a great business, just buy the shares, at least buy a small amount. But I'm thinking, if I bring out my crystal ball, swirl it around and then look into it, I would say that it's probably a hold for me, because I'd like to see this near-term uncertainty clear up a bit. I know that's silly because you tend to pay up for certainty, but I think there's so many other ideas on the market for me right now. It's a hold. I think it's good business, but willing to watch from the sidelines. Now, before we let people go, there are a few other companies we want to make mention of. I'll just rattle them off quickly, like I guess just a quick fire approach. I thought the Magellan result was pretty impressive. I mean, it's hard to fault a business that's spitting out so much free cash flow. Great funds management business.
Launching a balance fund too? Is that what the...
Yeah, so this is the... I was trying to get my head around this, Drew, because I don't know how it's going to go. I don't know. There's a lot of consolidation. They're bringing some business, like they like to, or at least not just them, but most people in the funds management industry like to lock in capital. We've seen a few moves to try and solidify that FUM inside the vehicle. This new core series, I think we need to hear a bit more from Hamish and Brett and all the team about this, but I think that's an interesting business, like a core series, which is kind of automatically rebalanced. I think that's an innovative product. The second one for me was ELMO Software, which is a HR software business. The market really didn't like it. It got sold off on the result, but we saw a huge uptick in annualized recurring revenue, more customers coming onto the platform organically. Obviously, during COVID, you still need HR, right? So I thought it was a really good result from an operating point of view. The next one for me is a share that I own, which is Altium. It should be out next week. Altium, we're expecting a softer result. This is a software company again that creates it creates a platform that designers can use to create printed circuit boards, or the things that go in your phones, for example. They flagged some uncertainty and a bit of pricing uncertainty. So whether that's deferrals or lower costs or incentives to get people onto their cloud platform. I don't like it when a company is supposedly a leader discounts its products. I find it, maybe it's strategic. We'll find out more.
Like the middleman between a graphics card manufacturer and a Tesla almost.
Yeah, exactly. So what they're trying to do is, if you think about the verticals, they kind of come down. You've got designers on one hand, you've got the manufacturing floor on the other. How do they talk to each other? And so over time, what I expect from Altium is that it moves further down to the manufacturing floor, and the designers can go from designing to actually implementing that with the manufacturers, and it becomes this really sticky ecosystem. That's my big expectation. It's probably quite a way off, but in the near term, I was looking at Cadence Systems, which is one of the competitors, US listed, recently released its second quarter results, looked really good. So, we're getting some news, which maybe this isn't that great, but this company's doing really well. I kind of just want to actually understand what's going on. And it sounds quite trivial, but I think, management have kind of, flagged some issues with Altium. But this other business is doing quite well, so I want to get to the bottom of that. Last one from me is Kogan. Come out recently with an announcement saying, year over year, its sales are up 110%. gross profit jumped 160%. Obviously, a lot more people going online with this e-commerce blitz. So another business that I'll be watching closely. How about you, mate?
Yeah, I'm keeping an eye on Kogan. I've had anecdotal reports of slow deliveries. So whether that's going to be an issue on sales over the next year or so, but I think this year's result will be fantastic. I've got one big one that most people laugh at, which was AMP. I think they couldn't trip over themselves anymore this week, but delivered a pretty good result considering. Up 10 or 11%. I think the market just closed before. Announced a special dividend after selling their insurance business. Personally, I hate insurance, anything insurance. It's an incredibly difficult business to manage. And you compare it to, so they've got 200 billion in assets under management, AMP capital, which is things like airports and toll roads, 120 billion in superannuation platforms. And they're valued at less than, no offense, Afterpay and companies like this. So fast growing companies versus, I think it won't be long until someone sees value in at least one of those businesses, whether it's demerged or sold off.
I think that was another business where I shot myself in the foot, Drew, thinking that maybe it's not going to pay a dividend. But we saw with some divestments recently, the life business, that they were able to pay that special dividend and take back more of AMP capital, which I think is the best business within the set, to be honest. I think that
100% ownership.
Yeah. And so I think when you're looking for a business in a turnaround, you want a management team or a board that can be easily influenced to control that business unit. And, I think they may or may not have had that for a while. So looking at that, I think that's a good move. They've also announced the share buyback. It's a pretty modest share buyback, but it could provide a floor under the price for the next 12 months. So interesting one. Was that your Telstra effect?
That was the Telstra effect on AMP. I think it's held by so many people after demutualisation. People probably didn't know they held it for a while. But when it gets in the paper, they realise they don't like it and sell it. And then, the vultures or the deep value people can come in and try and be patient and let it recover. Yeah,
for sure. Have you got any others for us?
I did have Telstra, but that was a bit of a disappointment too. The Telstra effect. I don't see Telstra the way everyone else does. I see it as a digital infrastructure of the future. They reported their 5G networks now at 33% of Australia. They're targeting half of Australia by June next year. So they brought that forward, and I think brought forward $500 million in CapEx to do it. But market didn't like it. It was off 8% today. Held their dividend. They're probably two of the most boring picks you can get. So,
but boring's good, right? If boring pays a dividend and boring, compounds modestly year over year, that's what you want. Yeah,
I looked at. So if you strip out their NBN losses, so losing customers to the NBN, they actually increased profit by 40 million last year, which is a solid result, but it's not the headline figures.
No, it's not.
It could be negative. So.
No, but you got to look through that, right?
Yeah.
Yeah. Cool, mate. Well, this has been longer than we expected, but there was so much to talk about. So I'm glad we could sit down and do it. I would encourage people that want to hear more of what you got to say to find you. You can go to the Wattle Partners website. We'll put links in the show notes, but you'll also be able to find all of Drew's writing on the Rask Media side, on the Inside Investor. So, mate, next week, do it again.
Sounds good.
Great. All right. Thanks for joining me, mate.
Thanks.